Another thing I wanted to dive into a little bit, which you touched on earlier, was the seasonality of your market. Um, the I think there are a number of implications to this, and I think we fortunately understood this pretty well when we were going into Atlantic City. Um, but it's easy to sort of underwrite to a certain annualized. So obviously, seasonality is going to play a big part in the performance of STRs. Um, the I think it's easy to think about things from an annualized perspective, and I think that's generally, I would say, just having been around real estate for a while, my mind is sort of trained now to think about things, particularly rental numbers, rent revenue, as either a monthly or annual figure, and that sort of assumes or implies averages and kind of stable monthly cash flows.
Yeah.
But the reality is, I think our Atlantic City stuff is a pretty heightened example of this. Our 12 months worth of rent, of our 12 months worth of rental income, maybe 40% of it comes from July and August, the two biggest months, and maybe 60 or 70% of it comes from like May through August, May through September. So if you go in and you're underwriting, let's say $100,000 a year for your rental, for your STR in a certain market, but you don't understand seasonality, your expectations are the way that you price and approach your listing can be vastly off in either direction. Whether that means you just kind of price it at a fairly static nightly rate, maybe a weekday and weekend rate over the course of the year, or you just overprice it based on the season. You're probably going to be either leaving a lot of money on the table, or you're going to be seeing way more vacancy than you otherwise should, because you're pricing yourself out of the market for that season.
Yeah, and I think all these factors that you just mentioned are factors that would go into, in my mind, selecting a market. So, for example, if I don't like a market where I have that huge seasonal variation, or if I don't like a market that appeals only to solo travelers or to family travelers, or if I don't like a market that is extremely driven by one particular amenity there for whatever reason, those might be reasons why I wouldn't choose that market. Like, I think if I were, for example, looking at a place where I thought the main draw was one business, just like I might not be interested in such a place for a long-term rental or whatever, there's so much, would there be so much concern in my mind that one business might move its offices or change or something like that, that maybe it's not a great short-term rental option. Or, I don't know if it would be kind of fitting in what we've done before, if we're looking at a market where the only people that are going to be renting there are retirees or something like that. I don't think that really fits in kind of with their, the brand. And then there are, I think retirees do use Airbnb, and I think there are markets that appeal to them. I'm thinking of like where I grew up in Florida, but I think having STRs there would be odd. It would be not within our kind of larger, brand scheme. So those are what we just said. Ryan, I don't know if you have other factors in that same capacity, but I think the things that we just said are the factors that we're kind of considering going through our mind to select a market, outside of some more kind of practical logistical factors that, maybe we can touch on shortly. But
yeah, I think maybe the last thing I would say to summarize all of that, or to add into all of that, is at the end of the day, despite how we've talked about short-term rentals as sort of their own asset class, at the end of the day, it is still real estate. In a lot of cases, it is still residential real estate. And so it bears mentioning that you should also understand what the real estate market looks like as a whole, agnostic to short-term rental usage.
Yeah.
So you might want to think twice. For example, if you can find the most perfect STR opportunity, seems like it's going to absolutely kill it from a yield perspective, from a cash flow perspective. But if your underwriting shows that, if you have to pay $1 million for this house, despite really high revenue numbers and cash flow projections, if there's no other house in that market for above $400,000, you're putting a lot of faith in the short-term rental
Yeah.
concept, and with factors like regulatory risk, and all of the other risk factors and obstacles that one endures going through the operations of short-term rentals. That's a pretty big bet to take, because you're sort of foregoing any sort of plan.
Yeah, I think thinking holistically about short-term rentals as an asset class, I know we just did an entire podcast episode on this recently, but one of the biggest concerns, I think, is that short-term rentals are pretty affected by macroeconomic factors that you have no control over. If you're doing a long-term rental, people need to live somewhere. It doesn't matter if the economy is doing bad or good. People are going to live somewhere. Maybe over time, people might move out of a certain area for particularly notable events, like we've just gone through and seen that in Manhattan, although now I think things have been improved. But with demand for short-term rentals can evaporate kind of immediately if there's some factor. Like, again, I'm thinking of, like, say, 9/11 in New York City that completely destroyed the tourism market in New York City for quite some time. So that's just, if you're uncomfortable with that kind of like macro risk that you can't control at all, then short-term rentals are not the best asset class to invest in, I suppose.
So I think all of that is a good like analytical framework to think about how to evaluate a market. I guess my original conception of this conversation was that we were in part going to have a conversation that we were due to have between the two of us about how operationally we would go about entering a new market. So maybe we can kind of shift the second half of this conversation to cover that topic, as this is very topical considering we are in this position now.
So I think for Ryan and I, what Ryan is touching on a little bit is that all these factors that we just talked about are important, to some extent are gating issues about whether or not we'd even enter a market at all. But other factors that are important to us are there are sub factors within this larger factor, but I think the biggest overarching way to say it is, would we be interested in expending our time and money and effort to operate in that market, even if the market had all of the attributes that we want and that we talked about? And I think for us, that's has more recently been something akin to, we still want to be able to physically go to these assets, maybe not, on a weekly or monthly basis, but the assets have to be in some sort of reasonable distance of where we live, which is the New York City area. I think we kind of said like 2 hours, something like that. I think that kind of feeds in a little bit to our very first point, your very first point, Ryan, about location versus asset demand. What we think is that essentially anywhere 2 hours in any direction from where we live, not the ocean, obviously, but any 2 hour, direction on land, there is a lot of demand just driven by the fact that it's 2 hours driving distance from New York City. So that could be on the ocean, on a beach. It could be on a lake. It could be in a river. It could be in the mountains. Could be in the forest, whatever. And that's all 2 hours from where we are. Whatever that is, there will be people that are interested in going there just because you're 2 hours driving distance from New York City. And I think, frankly, the same is true all throughout the Northeast Corridor. So from DC to Boston, if you're 2 hours anywhere from any of those major cities, Philadelphia, in that area, you will have demand. And for us, I think relying on location demand, I think is, just as a general concept, presents less risk than relying on an asset, because even if our assets in that area are not great, we'll still do well. And Atlantic City is a great example of that. Some of our assets in Atlantic City are not the greatest, but those assets still do really well. Our nicer assets do better, but we're still performing great on those assets.
Don't forget to visit us at brickxbrickrealestate.com for free content to help you along your real estate journey and to follow along on our projects. Subscribe and rate us on your favorite podcast app and engage with us online via Facebook, Instagram, LinkedIn, and brickxbrickrealestate.com. See you next time on the Brick by Brick podcast.